Hi, it's Rob Moore here. Now, I was having a dinner meeting with one of my very good friends I went to school with, who's become very high up at Santander, and he works in the commercial lending department. He's number one out of the 400 people in the banking world at his level, and he lends to a lot of the big players in property, many of whom are on the rich list. One is top 10 in the rich list, and we had a really in-depth chat about diversification and how much you should or shouldn't diversify, and over and under exposure and that kind of thing. And I'm sure you've thought about how much you should focus versus how much you should diversify. And I just thought I'd share some of the things we discussed, because that's actually got into quite a deep conversation. So the first things first, when it comes to diversification, especially in disruptive times like we are now, is when you're starting and maybe you don't have a huge amount of capital or a huge amount to invest, you don't want to diversify too much, because the more you diversify when you start, the less compounding and critical mass you can build to get something to pay in return. So like, for example, if you spread your time across 10 different income streams, how long would it take you to get 10 income streams to the level that are paying you passive income, whereas if you just focused on one? So you may, for example, at the moment be focused on serviced accommodation, or you might be focused on rent to rent. And you'll want to look at spending at least 70% of your time on your main strategy if you don't have any other strategies that you could invest in or any other money that you could have to diversify. But in disruptive times like we are in now, with Brexit, bank disruption, finance disruption, you want to be looking at where you are most exposed and least exposed, and where you are over and under leveraged and where you could leverage more and less. So my friend, for example, who works at Santander, is looking to retire when he's 40. He's 37 now, and he's reticent to put his money into property. And I was suggesting to him that he probably should put his money in property, because it's probably the best pound for pound return. With the money he's got, he could sort of leverage it probably by a multiplier of 5. But he made the point that because his career, his work, his vocation is property, and then if he put for example, his own money into commercial property, if something happened in the world of property, he might lose his job, and he might be exposed in the property world, in the property investment that he's made. So he's got double exposure there. So whilst I prefer property, he kind of doesn't, because he feels doubly and overexposed. And I thought that was quite a good point that he made. Now, what he's doing a lot of at the moment is lending his money on Funding Circle, and he's making 12%. But the reason he's making 12% over someone who normal returns on Funding Circle is about 8%, is because he knows how to assess risk lending to individuals, because that's what he does all day, every day in the commercial lending world. So he's gone from 8 to 12 because of his skills. And I said to him, well, because he's looking at refinancing his house, taking maybe 900 grand out of his house and putting it into Funding Circle. And I said, well, if you put all that money into Funding Circle, you're exposed there, because that's one individual platform. What happens if they get disrupted? People like me doing videos like this, if this gets watched 10 or 50,000 times, then quite a lot of you watching are going to go and set up your own Funding Circle account, and you're going to go and lend on Funding Circle. So then there's more competition in that market, and therefore that 12% gets competed and probably gets eroded down to 10 and 8%. And then he puts all of his money in that, and then something happens. So he's thinking, well, he wants to make a good return on his money so he can quit his job by the time he's 40. But I suggested he may be overexposed in that area. I said, well, are you looking at a capital play or an income play? And I suggested, maybe he could look at other alternative investments, like, for example, watches. Now, if he puts money into classic watches or classic cars, for example, if he buys the right ones, he's completely diversified away from Funding Circle and property and his job of commercial property lending, and also he's got, I don't know, he's probably got £1 million or something like that in the stock market. But the problem with that is he has no real passion for that, and he doesn't know what kind of watches to buy and not to buy, and I do. And therefore he probably wouldn't be as interested in going down that road versus Funding Circle, which he's really passionate about. And also what all he's doing is tying up capital, and he's not got an income stream, because you don't really have an income stream. Well, you don't have an income stream on capital assets like classic cars and watches and any other things that are investable collectibles. At the moment I invest in Lego, which is providing quite a good return, but it's a capital return. You've got to think about, okay, where am I going to put all these assets? Where am I going to divide my time and income streams into? How can I build multiple streams of income without diversifying too soon, but not overexposing too late? and balancing capital versus income. So one thing he did, for example, was he had virtually no mortgage, and he recently re-geared, and he got a big lump out of his mortgage because he got something like 1.75 over base. So he got a great deal at the time. So the next thing you have to think about when it's focus versus diversification is what's the deal you can get at the time? Because if you can get money at 1.75% a month and you can make 8 to 12% return, you've got massive arbitrage there on what you borrow at versus what you can get as a return. And then you've got to think about, okay, so where are the new disruptive opportunities? Like right now, you've got peer-to-peer lending, you've got crowdfunding, you've got cryptocurrencies, although, Bitcoin maybe is now, I wouldn't say you missed the boat, but certainly people were making really big returns in the earlier days of that. But there's going to be the new version of Bitcoin, there's going to be other cryptocurrencies, online currencies, and there's going to be other new lending platforms like Funding Circle, and there's a lot of disruption in finance. What you're balancing is looking for those new ones, like my friend found Funding Circle, because he's been doing that quite a long time, that you get the early mover opportunity where you can make your 12% or even maybe a little bit more because no one else is doing it because it's new. But you've got to balance that with, if you're overexposed in all these new things and they don't kick off, then what percentage of your income are you going to put into these new disruptive strategies, technologies, if you like? Whether you're watching and you're a property investor or you're just a general sort of enthusiastic investor, and I'm both. But going back to the property play, you've got single lets, which is being disrupted right now because you've got the tax grabs, as they're called, the reduction of mortgage interest relief, the stamp duty if you move your personal properties into a company. And so the income that you're looking to get, that you're able to get from single lets, certainly as we move to 2020, is being reduced. It's not as good, and some single lets may not even cash flow anymore. And you're probably thinking about, well, what do I do in property? But that has caused a movement to rent and service accommodation and more income strategies that aren't as much capital based. Let's say you had some rent and some service accommodations which offset your single lets. You had a commercial property that you're developing that you're going to sell the units out in 1 to 2 years. So that's capital. Service accommodation, rent are quicker income. Your single lets are the standard ones that are going to just always be there and probably never be disrupted. In terms of they won't get regulated in 3 years like rent to rent could or lease options could. And then you move some of your money away from property because if the property market, if something really significant happens to that, you don't want to have all your assets into one thing. If that got totally recession, crash or full disruption, you need to be able to afford to not have to sell when these things happen. And people go bust because they're forced to sell when the market reduces. You want to invest when the market reduces. So when there was the news of the Brexit, for example, we played long on the dollar, short on the pound, and made virtually 10% in a day. That's what George Soros did on Black Wednesday. Some of the big companies like Lloyd's and some of the developers really got hit. Tesco's has been really hit recently. VW's been really hit recently. You want to be liquid in those times where there's a reduction or a correction in those marketplaces, so you can invest in and get value investing. You invest in where you buy low. But what happens is the masses are the other way around, where they sell at the wrong time when they can, and then they buy at the wrong time when the prices are too high, when confidence is high. So it's just kind of a discussion, really. I know it's kind of a little bit organic, but I just wanted to share it with you. So are you balancing capital and income strategies? Are you making sure that you're focusing to make sure that you get one that works well? And then are you diversifying in your niche of, say, property, and then also diversifying out of your niche? Also, can you create other types of income streams, like maybe training income or passive income through books, products, audio books? I mean, if you could write a Christmas #1, that'd be an amazing asset, so intellectual property. And then when you've got these various different types of income streams, what you have is you have recession-proof and future-proof. And I was listening to a podcast recently where the interviewer said that the average amount of income streams that a multimillionaire has is 8. Now, I don't know if that's true or not, and I can't verify that, but certainly I have about that many income streams. And you want to be careful to be not too over-invested as you become more successful, because they're the stories of people who go bust. All the developers and the property investors or the big tech companies that have the massive crash. They're fully invested in one thing and they're exposed. And you want to be to the point where 4 of your 8 streams could be completely disrupted and go overnight, and you can still live on the other 4. And that does include having some cash. That does include having some physical. You know, gold doesn't create a great income stream, but gold is quite strong when things like Brexit and currency devalues and that kind of thing. So you want some physical as well, you know, some proper rainy day emergency stuff if there's proper war and looting. And these all kind of balance each other out. So just some things to think about.